While public markets are fixated on day-to-day swings, private equities have been making quieter moves. Our next guest says boring is bullish. Joining us for more on this is Erik Hirsch, co-CEO of Hamilton Lane. Great to have you with us. Thanks so much for taking the time.
Lindsay, thrilled to be here. Happy New Year.
Happy New Year. So why is boring bullish? Let's start with that.
Well, I think today the public markets are essentially riding the wave of literally 7 companies. So if you're all in on the public markets right now, if you are all in on a passive approach to equity investing, you should just understand as an investor that you have essentially staked your entire savings to 7 companies who are all focused on one theme, an important theme, a very major theme, but one theme nonetheless. I think the private markets are simply showing you that there is benefit to diversification, getting exposure across geographies and across a much greater array of industries that are frankly fueling a big part of our economies.
Very interesting. So you're seeing kind of more daily volatility in private markets? Is that what you're saying, or more in public markets at the moment?
Much more in the public markets. I think you just don't see the private markets as volatile. I think if you step back and just look at kind of industry exposure, it's really the private markets that are financing, banking, and acquiring the businesses that fuel our economy: local retail, manufacturing, power suppliers. So a lot of that is much more geared towards privately held businesses. And today in the US, for example, one of the biggest public markets, obviously, about 4,500 public companies. That's it. But if you look at where the returns have coming from, particularly in the S&P 500, they've been coming from, as you know, a very, very small number of companies. That's not a great dynamic, we think, for investors. And so if you're looking to create a much broader, diversified portfolio, we think that having a mix of public equities and private equities is the way to go.
For investors that maybe have never invested in private equities, do you have some tips in terms of how to get started and make that shift and mix in some private with public, as you're saying?
Well, I think the great part is that world has really opened up now to retail investors in a way that it just hadn't been historically. So for the last several decades, this was primarily an institutional investor game. Today, there's been a new array of products that are generally referred to as evergreen funds that are much more accessible to the everyday public investor, the retail investor. And so Hamilton Lane and a lot of our competitors have a variety of these products now that are available on a number of platforms with relatively low minimums. We, for example, have one of our infrastructure funds available at a $500 minimum. So that democratization of what we're doing in terms of getting into an asset class that was really originally geared to only very large investors has altered dramatically. And we think that's positive.
You say investors need to manage their expectations on exits. For those who are maybe new to the private world, or can you kind of explain what that means?
Sure. In the public world, you're seeing returns coming on a hour by hour, minute by minute, day by day basis. In the private world, if you think about it, just the concept of what that business is, you're acquiring a company today, and you're looking to improve it, to grow it, to fundamentally make it better, to ultimately sell it in the future. If you look on average, that has historically taken 4 to 5 years to achieve what we would deem sort of high rates of return, but it's a 4 to 5 year process. So the private markets are not where you'd want to keep your liquid capital. That's much more what the public markets are geared towards, where you have constant daily, minute by minute liquidity at your fingertips. The private markets are offering vehicles that are more illiquid or semi-liquid, where you're going to be thinking about this as a much longer duration investment and needing to have the patience and the discipline to do that. But in the long run, you get rewarded for that. And if you look at the institutional investor, today on average, they're putting anywhere from 20 to 25% of their assets into the private markets. Most individual investors today have about 0% in the private markets. So I would say look to the sovereign wealth funds, look to the pension funds, look to the banks, look to the insurance companies, and look at how they're building portfolios, and then ask yourself whether that might be a good model for you as someone who is individually saving for retirement.
Interesting. Yeah. And as you say, it sounds like patience is a virtue, really, when it comes to private investing. When it comes to helping clients to manage their expectations, what else are you telling them?
Well, I think we're telling them a little bit of the where do you get diversification. We've been told so long now that the really best way to attack the public markets is going with an all-indexed, very, very low-cost approach. And while that has some huge benefits, Today, we've never seen concentration in a small number of companies anywhere near that we have today. So you basically have the top 10 companies in the S&P 500 accounting for almost 40% of the index's total market cap. You have to go back to the late 60s, early 70s to see anything close to that. The difference is if you go back to those earlier years, when you saw that concentration in a small number of companies, the companies were not correlated to each other. So there was an IBM and there was an Exxon. Today, that concentration is at all-time highs. And as I mentioned earlier, hugely correlated to each other, in some cases with a lot of inner dealings back and forth with those companies. So I think what we're doing is also educating people on the private markets, is getting you exposure to a much smaller company base. So market caps typically single billions of dollars, not trillion dollars, and getting you exposed across a much, much wider array of industries. And we think that's important for building out an appropriately diversified portfolio.
Just as a last question here, we saw in the public market Canada's resilience throughout this year compared to the U.S. markets. Does that same resilience go across to private markets as well? Are we seeing kind of a similar thing?
It does. I think so goes the economy, so goes both publics and privates. I think the Canadian public market much more diversified across industry and sector. And so that's just been benefiting from some relative strength of the Canadian economy.
Okay, very interesting stuff. Erik Hirsch, co-CEO of Hamilton Lane, appreciate you joining us. Thanks so much.
Pleasure being here. Thank you.